So today we'll talk about the different types of life insurance. The types we'll discuss are term life insurance, universal life insurance, whole life insurance, and then also institutional life insurance. This will provide some insight as to how large corporations and even banks purchase life insurance. Let's start with term life insurance. So for each of the types of life insurance, we're going to look at our life insurance chart. And beginning with term life insurance, there's two main types. We've got the words level and then also annual renewable. Let's start with level. Actually, first, the approach with term life insurance is always life insurance. So term life insurance does not build any cash value. Therefore, if someone is interested in term life insurance, they're typically getting it because they want life insurance protection. Now, what a level term policy is, it means that you are purchasing a life insurance policy with a death benefit that is level. It will not increase after you start the policy. Whatever your premium is guaranteed to be level for the length of that term. You can typically get a level term policy with a term of anywhere from 5 years up to 40 years. However, the most common terms are typically 10, 20, and 30 years. So an example would be I want to get a 20-year term life insurance policy with a death benefit of $1 million. So if I do that and say, okay, I want my $1 million death benefit, and this is a level term policy, which means I picked 20 years when I started. That means the death benefit of $1 million is level for the full 20 years, which is nice. Also, the premium, whatever that dollar amount is, which will vary depending on my age and health, that is also guaranteed to be level. So the premium might be $1,000 per year. So you pay that $1,000 every year, and it's guaranteed, again, to be level for a 20-year period. So it will not increase. Now, what happens at the end of that 20-year term? The policy expires. I no longer have life insurance. If I still want life insurance at that time, I would have to purchase a new life insurance policy, which would be based on my age at that time and also my health at that time. If I have a severe health issue now, I might even be uninsurable. So it's always good to be aware of that when purchasing a term life insurance policy. How long do I want to have it? What do I need to protect? A reason I might get term life insurance is because I have a mortgage, I have a family, maybe my income is $100,000 per year, and if I die, my family is no longer going to receive any of that income. Therefore, I'm getting life insurance to protect that future income. That is a common reason why term life insurance policies are purchased and why they're sold. Now, because it expires after 20 years, assuming I get a 20-year term policy, what happens to all of the premium payments? How much did you pay? 1,000 times 20 years is $20,000. It's gone. It's a lot like paying rent. If you buy a home and make mortgage payments, you build what? Equity. That's your money that you can access. If you pay rent, do you build any equity? No. It all goes to the owner. You have a place to live, but you're not building anything with those payments. Same thing here with a term life insurance policy. So that is a level term life policy. Next, we have what is called an annual renewable term policy. So annual renewable, let's call this ART. How this works is I don't have a fixed term when I start. It is a year-to-year purchase. Now, when I look at an annual renewable term, it almost always starts out with a lower premium than what I would get with a level term policy. So, for example, when I looked at the level term, I had an annual premium of $1,000 per year. This might start with a $400 premium in the first year. But then when I look at the second year, that premium is now $700. which is still lower than the $1,000 per year level term. But then when I hit the third year, now all of a sudden I'm at $1,050. So it's called annual renewable term because every year that that term renews, it's going to renew at a higher premium for the same death benefit. So this is nice because I can start with a low cost. If I have a short-term liability, that's typically where this type of product makes sense. However, if it's a liability that I'm going to have for a long time, or I want protection for a long time, this product usually does not make sense. But how it works is the premium is going to increase every year. And it'll either get too high where I can't afford it anymore, or it'll get too high where I just say, I'm not keeping this thing anymore. It's too expensive. But that's term life insurance. All right, let's continue on. Next, we will look at universal life insurance. So the approach with universal life insurance is life insurance for a lot of people, but also cash value. In fact, we actually see more people express interest in universal life insurance for the cash value than we see for the life insurance piece. The reason why is because when we look at the cash value in a life insurance policy, I can access it tax-free. A big selling point of universal life products, particularly indexed universal life insurance, is that you can take income on a tax-free basis and it can really project fantastic looking income long term. Keep in mind, I used the word project. I didn't say it actually produces it. That's a whole nother topic though. So, looking at the three types. First, we've got indexed universal life insurance. What this means, the index, is that your cash value is linked to an index. The most common is the S&P 500. How this works is if we take the S&P, your money is not invested directly in the market, but if the market goes up, your money will go up with it. If the market goes down, your money will not go down with it. Your principal is protected, where typically you have what is called a 0% floor. Now, with the death benefit, there's two options with an indexed universal life policy, option A and option B. Option A is a level death benefit, and option B is an increasing death benefit. And you can actually switch back and forth after you start a policy, which is nice. If you're interested in cash value, typically we see a combination of both. We may start with an increasing death benefit that starts lower, and then if we stop payments, we'll flip it over to a level death benefit, and then eventually that'll go back to increasing. There's different things you can do to try and optimize the cash value performance. Now the premiums are very flexible here. You can purchase an indexed universal life insurance policy in a similar way that you would purchase term, where you say, I want a $1 million policy, tell me how much it costs. However, because the approach is cash value, most people don't do that. Usually someone is saying, hey, I want to put X amount of dollars into this policy, or they meet with an agent or an advisor, and that agent or advisor builds out a plan where they say, hey, we see that you've got money over in these different assets, or from your cash flow, we're able to move $10,000 per year into an indexed universal life insurance policy, where the focus is going to be accumulating cash value for your retirement, and then we'll show you how you can take money out during retirement. That's usually the sales pitch there, just in my experience. So I might fund the premium for 10 years, or maybe it's for 20 years until I hit age 60. It can be customized, which is nice. What I'll see is that the cash value will project to go nowhere but up over time. But here's the thing to be aware of with this product. Full disclosure, we do not use this product at our company as of right now. And the only reason why is because we have seen zero proof of performance. Big problem in the life insurance industry is overpromising and under-delivering. We have not seen strong proof of performance with this product. Not saying it's not possible, that's just why we don't use it. So an issue with it is we have COI, which stands for cost of insurance, and then also cap rates, both of which can be controlled by the insurance company. So the cost of insurance works just like annual renewable term that we covered earlier. So it starts out very low, but as we get older, it gets more and more expensive. So if the policy performs, the cash value growth is supposed to always easily outpace the cost of insurance. Again, this is with an indexed universal life insurance policy. And illustrations will almost always display that when I look at the non-guaranteed side of things. Here's an issue though. When I look at the cap rate, this might start at 11%. And what a cap rate represents is if I'm tied to the S&P 500 and the S&P does 30%, the cap, which limits how much I can earn on any given year, if that's 11%, I'm capped at 11%, which is still not bad when I consider the fact I can't lose any money with this product. Here's the issue that we've seen occur a lot. After someone has had a policy for a long time, that cap rate is dropped. The insurance company reserves the right to lower the cap rate. So if they lower it to 6% and the market does 30%, you're capped at 6%. That 6% is also a gross rate because we still have to take into account the cost of insurance and other expenses that come with life insurance. So the main item to be aware of if you're exploring an indexed universal life insurance policy are those variables that are outside of your control. What you can do if you're exploring this product is just request to see illustrations based on the guaranteed values and also conservative assumptions. Conservative assumptions does not mean that the current assumption is 6% and then you look at 5.5%. No, I would look at a rate somewhere between the minimum guarantee and whatever the current assumption is. The current assumption is when you look at an illustration, it'll say current assumption or current illustration based on current rates, that is. But that's an indexed universal life insurance policy. Market goes up, you go up with it. Market goes down, your principal's protected, so you can't lose money if the market crashes. However, what I want to be aware of is the increasing cost of insurance and then also the cap rate that it can be decreased after I start a policy. I'll conclude this piece with a quick story. We've studied a lot of indexed universal life insurance policies. There's one that was issued in 2008. It's on an individual who was 46 years old at the time, healthy guy. He actually had a 1035 exchange as well, money that went into the product. And the illustration was showing 12 years down the road, he should be earning about 9.2% per year as far as the net growth rate. We studied the policy in 2020. And how we studied it is we looked at the annual statements, what had actually occurred for him, meaning the real performance. And over that period of time, which was at a good period of time in the stock market, it was from 2008 to 2020. That was a bull run. The net return, the average, was almost a clean 2%. And when we look at 2020, so we looked at 2019 through 2020, where the original illustration showed a 9.2% return, his actual return that year was less than 1%. It was 0.91%. All based on the original design of the policy. The reason why it's underperforming or it had underperformed so much is because when he started the policy, the cap rate was 15%. Whereas in 2020, the cap rate had come all the way down to 6%. So his upside was severely limited. And then also the insurance expenses kept on going up, kept on eating into his cash value. Obviously, he wasn't very happy when he thought he was going to be earning 9% plus per year, and he's averaged 2% by that same point in time. So stuff like that is what we see, and it's a big reason why we're not that comfortable, because we have not seen any proof of performance with this product yet. All right, so next, variable universal life insurance. This is similar to indexed universal life insurance in the sense that you have an increasing cost of insurance, so the COI can go up. The difference, a big difference, is there's no cap rate, so we don't have to worry about that, but there's also no floor. So it's kind of in the word, or in the product name, it's a variable policy. When you hear that, what do you think of? Well, it's variable. My money can go up and my money can go down, which is true. It's exactly what happens. So with a variable universal life insurance policy, this definitely offers the most upside when it comes to your cash value growth. The reason why is that your money can be invested directly in the market. Typically, it's mutual funds. Now, you do have to have an advisor that is securities licensed in order to obtain this product, as carrying just a life insurance license does not allow you to sell it. You need a securities license, which is the same type of license that would allow you to sell mutual funds, and then you've got different securities license for stocks and bonds, all that good stuff. But because my money can be invested in the market, what does that mean with respect to your cash value performance? Well, it can really shoot up over time, which is nice. Now, at the same time, what if the market goes down? Well, it can go down as well. So I've got a variable aspect there. Now, historically, this policy in many cases has done very well when the approach is cash value and the advisor sets it up for cash value. We don't use it just because we don't carry that specific license. However, where I've seen people successful with this is with what is called private placement life insurance. However, this is something that is typically reserved for those that are very wealthy. It's typically the minimum amount people are contributing here, usually $5 million, and that's usually done with a deposit of $1 million per year for 5 years. A lot of times it's even more than that. The reason why is because how most advisors are paid on this is the money that you're depositing into this policy. They're managing that, and they're typically charging very low fees. I mean, most of them will, to my understanding, but they're charging a very low fee on the total amount of money under management with that product. So you can really hit a home run though, being that the money is invested in the market. But at the same time, you've got risk there because it is a variable product. It is a type of universal life insurance policy though, and what that means is that the cost of insurance will continue to increase over time, which is beneficial to be aware of. All right, the last type of universal life insurance is referred to as guaranteed universal life insurance. What does that mean? Well, it's kind of like term insurance, kind of. Here's how it works. So with a guaranteed universal life insurance policy, what is guaranteed is the death benefit. This type of product is not so common if my goal is cash value. It is very common if my goal is life insurance. So I might get a policy that has a $1 million death benefit, and that is guaranteed to stay in place forever, my entire life. So the death benefit is guaranteed to remain intact forever, and it can be set up where I pay premiums forever, so I can pay a very low premium in order to keep that death benefit forever. I have to pay it indefinitely, or I can set it up where I pay a premium maybe only for 10 years, where I can pay it up early. So for example, I can have, call it option A, where I pay a premium of $5,000 per year. Actually, it'll cost a lot more than that. Let's say it's $15,000 per year forever, or I can pay it up in 10 years where now I'm going to pay, this is option B, $40,000 per year. But after the 10th year, it's fully paid up, and my death benefit is still guaranteed to last forever. Sometimes I'll see a little bit of cash value build during the early years, but often what happens with these is it goes down. However, what these usually have associated with them, and I would always recommend it, is what is called a guaranteed no lapse provision. A lot like a level term policy where I'm guaranteed to have that death benefit for that level term of 20 years. The difference with this is that it can be set up where it's guaranteed not to lapse for 20 years, 30 years, until I'm 100 years old, or maybe I make it 110, where I know I'm not going to live that long. My point is, I can set it up where I'm guaranteed to have a death benefit that's paid to my beneficiaries. And why I would select this product is because to get a guaranteed death benefit is typically expensive. This product allows me to lock in that guaranteed death benefit at the lowest cost possible. That's typically why individuals select this product. They're most common in estate planning cases, where we'll usually see someone with a high net worth not get a $1 million policy, but it might be a $30 million policy, or $10 million, could be anything. And what they're using are other assets that they have to pay that premium, whatever the dollar amount is. And then the death benefit may be used to cover a portion of their estate taxes or something like that. But this is a common product that is used if I am looking for life insurance from an estate planning standpoint. Fun stuff, right? Learning about life insurance. You ever think all of this stuff was available? All right, we're coming down to the home stretch here, I promise. So next, we've got whole life insurance. So with whole life insurance, you can approach it for life insurance. Not that common though. I'll say this, everyone that our company works with approaches this for cash value, because if you do it right, it can work extremely well. Now, there's two types of whole life insurance products. We've got traditional life insurance products and then limited pay products. A traditional life insurance product might be called a whole life 100. You know what that means? That means that the premium is due until you're 100 years old. Literally, you could pay forever. Not everyone does that, but that's how long the premium is contractually due. If you didn't want to pay it that long, you could just have it paid by the dividends and interest, or you could exercise what's called a reduced paid up and kill the premium altogether. But an example of a traditional policy is a policy that I can pay forever. I can usually get a death benefit at a lower cost. So let's say I get a $1 million death benefit. If I'm 40 years old, the premium might be $15,000 per year. And if I pay just that premium, I don't add anything else into the policy, my first year cash value will look absolutely horrific, as it'll be a zero, which means you paid $15,000 and you have nothing to show for it. Now, as you keep on paying that premium, 10 plus years down the road, you'll finally see more in cash value than what you paid into it. So getting a traditional policy and paying just the premium is not a very good approach if you want high cash value. How we would maximize the cash value here is, instead of saying, I want a $1 million death benefit, one might say, I want to put in $15,000. We'll use the same dollar amount we just looked at. So that's how much I want to fund the policy with. But I'll set the premium at $1,500. That's 10% of your total out of pocket. And then we'll add money to what is called a paid up additions rider, or PUA rider, where the other 13.5 goes. The premium, whether it's $15,000 or $1,500, does not build any cash value in the first year. However, the PUA does. So now my first year cash value is going to be somewhere between $13,000 and $13,500. So this approach, where I am maximizing the paid up additions rider, gives me high cash value right out of the gates, and the cash value accelerates. The death benefit will also increase over time with a whole life insurance policy. And with a whole life insurance policy, the death benefit is guaranteed to stay in place forever if A, I pay the premiums forever, or B, if I heavily fund it for a period of time and then I stop, maybe it's after 5 years in a case like this, it'll be very easy to still have a death benefit that is guaranteed to remain in force forever. And we can show some examples of that as well. But a traditional policy is a policy where the premium is due forever, whereas a limited pay policy, it's still a whole life insurance policy. The difference is that I might only be able to pay the premium for 10 years if the policy is called a 10-pay policy. So the most common example of a limited pay policy is a 10-pay product. Let's do this. 10. So with a 10-pay policy, the premium is due for 10 years. It does not mean that I have to pay for 10 years, but that's how long I can pay. Now, the cash value and being able to add PUA riders like what we just described with the traditional whole life insurance policy is the same thing. The difference is when I look at a 10-pay product or most limited pay products, when I measure the cash value growth, you will see a higher growth rate or an internal rate of return. That's a fancy way to say the average growth rate. The cash value will often perform at a much higher level. We've got several videos that explain exactly why that is and how that works. However, when I look at limited pay products, I will often see stronger cash value growth than what I would see in a traditional life insurance product. And there's two main reasons why. One, insurance companies will often design limited pay products for cash accumulation. You'll even see that in their marketing material. But two, when you look at the commissions on limited pay products compared to traditional products, they're much lower. The reason why is because the insurance company is giving the policyholder more of their premium in cash value immediately, which begins to compound, which gives them more money as a result. There's more to it than all of this, but I do hope that you are enjoying this thus far. All right, those are the two different types of whole life insurance. If you want more on whole life insurance, check out any video on our YouTube channel, as we talk about it quite a bit. Lastly, institutional life insurance. So for this guy, the approach for an institution is almost always cash value. The death benefit does have some value here, but cash value is really what they're interested in. So the approach when it comes to institutional life insurance is almost always cash value. The death benefit is important to them. However, it's the cash value. Like, that's why they're putting money in this product. If we look at banks, for example, which I'm going to pull an example up in a moment, they are purchasing this for the cash value because it is viewed as an investment in many ways. So we're going to get rid of our chart here. There we go. So when I look at corporate-owned or bank-owned life insurance, the product that is used is a single premium universal life insurance, which means the insurance expenses are going to gradually increase over time. However, these are structured different for corporations than they are for individuals, where you will see positive cash value from start to finish, even though those expenses go up. So let's take a look at an example here. Here is an illustration of a bank-owned life insurance policy for a bank that we're working with right now. So policy count represents 16 employees that the bank is taking policies out on. We've got a one-time deposit of $5 million. Face amount represents the guaranteed death benefit. So if they only receive the guaranteed rate every single year, there's what the death benefit will be. And this is combining all 16 policies. Then we have the policy account value. This matches the net cash value. Why we have this column twice is because typically when you look at universal life insurance policies, we have what are called surrender fees or surrender charges. So you've got the account value, which is your money earning interest, then a surrender charge, meaning if you cash it out, the company will pocket that surrender charge. With bank-owned life insurance policies, we don't see that there. That's why the account value matches the net cash value. So the first year, they put in $5 million, they earned 4.57%, and they've got almost $4.25 million. So positive cash value right out of the gates. A death benefit of a little bit less than $10 million. They make 0 payments thereafter, and the cash value just continues to grow over time. Now, the crediting rate with this particular product at the time of running this illustration is 4.65%. Do you ever see it earn 4.65%? No, we don't. It's less than that in the first year, and it's less than that every year. In fact, it gradually goes down. Why? Well, this again is a universal life insurance policy, where I've got the cost of insurance going up every single year and a fixed crediting rate in this example. So if the crediting rate stays the same, but the expenses go up, that's going to drag down my net return. However, banks still do this because the net return is still positive, and it also has a sweet tax advantage, meaning it grows tax deferred. They can book it as a tax-free return, and they get the death benefit back income tax-free when the employees eventually pass. Now, the one thing I'll say about this is banks typically do not access the cash value because these are considered modified endowment contracts, meaning they would have to pay taxes and a penalty tax on the gains if they did access it. But that is an example of institutional life or institutional life insurance. The last thing I'll say is that a lot of small and large businesses will often use whole life insurance instead of a product like a COLI or BOLI. And the reason why is because with a whole life insurance policy, you can set it up where you can still access the cash value. You can beef the cash value up so it's very attractive on day one, whereas a pure BOLI or COLI, cash value looks really good, but we don't have much access to it right out of the gates. So I know that is a lot when it comes to the different types of life insurance. I do hope that you found this helpful. If you have any thoughts, questions, comments, please leave them in the comments below, and we'll see you in the next video. Thanks so much.
Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.